everybody. On behalf of the Rodrigo Center for Corporate Law and Governance, let me welcome you all to this public lecture, Blockchain, ICOs, and FinTech, the new ways to raise capital and new market regulations. This presentation is a part of the transactions course, and this is one of the educational innovations of Rodrigo Law School. Our students represent a fictional group of entrepreneurs and help them develop successful companies. So today, this is impossible without new technology, and one of the best experts on FinTech is here today. Our guest lecturer is Lewis Cohen, who is the co-founder of DLx Law, and prior to founding DLx Law, he was a partner at Hogan Lovells, and before that, Clifford Chance. And he's joined by Rodrigo Seira, who prior to joining DLx Law was an associate at Cleary Gottlieb, and he's a graduate of Harvard Law School.
We don't hold that against him, though.
I guess we should, but we won't. So both of them have already represented multiple clients on initial coin offerings and other ways to raise capital in this modern economy. Our Dean Lopez, unfortunately cannot be here tonight, but he has asked me to welcome you all, our speakers and guests. And without further ado, let me give the floor to Lewis Cohen.
Thank you very much, Professor Kusova. We're delighted to be here. I think for me, this is maybe my third or fourth time here at Rutgers Law, and it's a pleasure to be back, and particularly an honor to be here for the first time under the flag of our brand new law firm, DLx Law, and thrilled to be able to represent a new way of looking at the law and providing legal advice to clients in this space. Again, my name is Lewis Cohen. Professor Kusova gave us a terrific introduction, but we're pleased to be here. Let me just ask my colleague Rodrigo to say a quick hello, and then we'll get on to business.
Well, sure. Thank you, everybody, for coming today. My name is Rodrigo Seira, and I'm looking forward to having a conversation with you guys about something that's near and dear to my heart, regulation of blockchain.
Thank you. So we're going to give you a little overview of what we want to cover today, and tremendous credit goes to my colleague Rodrigo, who helped to pull the slides together. At this point, let me step back. When I first started looking at blockchain as a lawyer, there was very little out there in terms of resources to look to. Most of the dialogue when we talked about blockchain and Bitcoin was really simply around the payments. How do we deal with Bitcoin as a cryptocurrency? The idea that real lawyers, that transactional lawyers would have an interest in the space was pretty much unheard of. In 2015, I would venture to say no major law firm had a blockchain group, a blockchain department, a head of a blockchain practice. That was something that I was fortunate enough to be part of pioneering. Before I left Hogan Lovells, I was the head of the group there, and I think pretty much every major law firm you find right now has some sort of blockchain group. But very few people, I think, really do understand what this means. They know it's something they feel they have to engage in. Law schools feel, oh, well, we need to have a course, we need to mention this topic. Very few people really spend the time to understand what these words mean. And we hope after about an hour and a half with Rodrigo and me, that you have a little bit of a better sense what we're talking about when we use this term blockchain, why we're so excited to be in the space, and hopefully maybe some of you guys will want to be in that space as well. So we're going to start off with, I think it's always important to go back to fundamentals. Many people dive into this space and they want, well, let's write a smart contract and do an ICO and do a lot of this stuff, and they don't really understand where any of this comes from. And when we talk about cryptocurrency, you can't have that dialogue without talking about money itself. What is money? How does it function? What does it mean? How is it regulated? And Rodrigo's going to kick us off with, I think, a really interesting introduction. Some of it may be familiar to some of you, but I think there's going to be some really great material throughout that part. We're then going to go a little closer and look at Bitcoin. There are a lot of folks out there, particularly at the enterprise level and kind of quote-unquote big law, that say, well, Bitcoin, that's got nothing to do with us. That's the bad people. That's the money laundering crazy guys, crypto anarchists. We don't do that stuff. I would humbly put out to you that anyone who wants to be in the blockchain space and who doesn't have a deep and fundamental understanding of, and I would say respect for, Bitcoin as a protocol really shouldn't be practicing. It is essential to understand the roots of everything else that is built on top of it, regardless of what you do. So we're going to spend some time talking about Bitcoin, the Bitcoin protocol, how that works and what that means before we get into a little bit more depth. And the title of the talk, obviously, is Regulation. We're at a law school here. And we're certainly going to try and devote a lot of attention to regulatory and legal issues that come out of these technologies, what they mean and how, all of you, here watching from home will relate to this space as a lawyer from a regulatory perspective. We're going to leave, Professor Gustav has asked us to leave a fair amount of time for questions. Please, we welcome questions and dialogue. We're going to ask you to hold questions during the talk just because we do have a lot of material to cover, but we very much welcome questions at the end, and I think we'll have about 20 minutes or so there should be plenty of time to get into some really good dialogue. I think afterwards there's a brief reception, and Rodrigo and I will be available to talk more after the formal presentation and stuff. So Rodrigo, you want to take that?
Sure. Thank you.
I'll move here.
So I think a good way to start getting into this discussion is to just take a step back and think theoretically, what is money? And I think for a lot of people that I've encountered in this space, they have this common narrative. I think
I'll move it forward here. No worries.
There's a common narrative where they have this moment where they get it, or they alternatively will say they fell down the rabbit hole or something. And for me, that moment came when I started to really think about money conceptually and understanding it in different ways.
We lost the, we have an IT, I'm sorry, we lost the deck on the screen, which is, I think, why. I waited too long with the long introduction. I think we got to go through this. Okay, there it is. All right, we go.
So, I mean, money is everywhere. We all use it every day. So we all have kind of preconceptions about money. I think the most common understandings of money you'll hear are people say it's a medium of exchange, it's a store of value, or stuff like that, right? So I want to contrast, I think, two conceptions. One is what I see the most common, which is money is a commodity that is used as a medium of exchange. And this story is usually told as an evolutionary story with its hypothetical land of barter. And then at some point, bartering became too hard to do, too complicated, and then that's when we developed money, which was just basically a commodity that was fungible and accepted by everybody, right? And you can find this sort of account of money going back to like Aristotle, John Locke, so it has a very reputable academic background. Against that conception of money, I want to put to you the anthropological study of the Yap people and the Bitcoin white paper. And I think if you think about the Yap people, which we'll go into a little bit more, and Bitcoin, you start to understand that the really fundamental thing about money is not really the physical representation, the token. It's not really a commodity. What it really is a social technology for accounting debts and credits between members of one specific society. So here we have Yap. So the Pacific island of Yap was one of the most isolated places in the world. And in 1903, a New Englander named Henry, I think, Burroughs, visited. And this was a really great example because it provides a really clear counter-distinction to our conception of money, and these people had developed it in isolation of ours. So it's in a way kind of a pure philosophical alternative to an understanding of money. So the Yap was a pretty primitive society, and they had basically only three main commodities, which were fish, coconuts, and sea cucumbers, which were like a luxury item. So in theory, this type of society is the archetypal society for a bartering society, right? They only have three commodities, they live on an island, so they can't be too far away. So they should just be trading these things. But Henry Furrows realized when he visited that they actually had devised this very interesting money conception where they used very large rocks called fei as representations of money. And you can imagine these rocks were like, you can see them, they're like human-sized, not very portable, not what you would normally think of as coin or like a dollar bill. So maybe we can so physical transportations of these stones is obviously very hard, and this incited some interesting questions for Henry. And what he realized was that the Yap people would transact and use their fei, but they would never actually interchange it. In fact, there's a story that's recounted in a couple places where there was a family whose wealth was acknowledged by the whole community, and the source of their wealth was a really large stone that had fallen from a boat and was at the bottom of the ocean. But everybody kind of recognized it and still gave him credit for that value. So I think what this example really shows is that it allows you to abstract the understanding of money and divorce it from the commodity, the coin, and realize that what we're really talking about is a system of accounting. So I think another important conception to dispel is that money is only issued by sovereigns. This has definitely been the traditional experience in modern world. And I think this is for a couple of reasons, but it's not intrinsically so. So I think sovereigns in general just make a lot of payments. They are, if you measure it by like world GDP, payments actually made by sovereigns are the largest. They have a monopoly on political power, and they're seen kind of a representation of society, which is why I think they've been the de facto issuer of currency. But this has not always been the case. And interestingly, obviously, sovereigns have a vested interest in maintaining this role, because through issuing currency, they're able to fundraise. And this chart that I have here, which unfortunately it might be a little too small for you guys to see, it tracks what is called the debasement of the silver coins in the Roman Empire. So this is kind of the classic problem, right? The sovereign has an interest in fundraising immediately and will issue additional currency that will result in inflation and the price of the coin going down, right? So this shows how the level of silver in Roman coins was decreased from starting with Nero, which was close to 100% silver, to the point where it was something like 8% silver. And this is a practice that started with the Romans, but has continued to today. I think particularly poignant example is Venezuela today, with the hyperinflation that they've been experiencing and the actions that the government has been taking there to try to control it.
And I'm just going to say, I think we can make Professor Guzova the slides available for anyone who's interested after the fact. So we'll share. So if folks want to get a copy of the slides, no problem at all.
So even though for most of our experience we've associated money with sovereign issued money, private money has actually been around us this whole time. On the screen are just two examples of relatively recent issuances of private money. In Argentina in 2001, in order to try to curb inflation and capital flight, the government instituted what they were called corralitos, basically just capital controls. And this resulted in a lot of private entities in Argentina issuing their own like vouchers or basically currency, which ended up circulating in secondary markets and in a way replacing the peso. What you see there is a woman holding a couple of vouchers from supermarkets. Another very interesting example, it comes from Ireland. In the 1970s, there was a labor strike that caused most of the banks to close for something over 6 months. And however, while you might expect that didn't upload anything. well, you might expect that that would paralyze the banking system. Bank customers actually kept paying people with checks, and people kept accepting them. I think up to, it was like £5 billion. And the only difference was that like nobody could go cash those checks. So it was in a way private money, because at that point you're only issuing based on your own credit, right? Nobody can go to the bank and cash it. So those are just two kind of examples. So when we take a step back, after having thought of the experience of the app and kind of teasing out what the social implications of money are, we start to think of what their fundamental characteristics are, right? So I like to think that money is not really just a commodity that's a medium of exchange, but a technology that has three fundamental elements. It's an abstract unit of value. You need to have some value to determine it. It needs a system to keep track of who owns what at what point. And then you have to have the ability of that representation to be traded. So in a way, you can think of it as credit that is transferable. So now we move on to Bitcoin.
Terrific, thank you. So we spend time on the background of money because really once we started talking about Bitcoin, which as I said before is really fundamental to your understanding of anything to do with blockchain, you have to understand where Bitcoin came from, why it was created, and why it was such a critical breakthrough. Most, I think, folks understand at this point that Bitcoin was not the first attempt at an internet-based source of money. There were a number of prior examples, e-gold and others, but all of them relied on some centralized system in which you had to rely on someone to keep track of what there was. Interestingly enough, Rodrigo's example of the island of Yap was an example of a decentralized system. There was not one single keeper of the ledger of who owned which stones and what they were. Everyone in the community knew, and everyone in the community agreed, and we'll talk later about the Byzantine generals problem, and you'll see how that idea of consensus, everyone agreeing to who has what, is critical to the ideas behind blockchain, and ultimately the legal issues that underlie it. Bitcoin, excuse me, Bitcoin itself, of course, goes back to late 2008. The Bitcoin white paper from Satoshi Nakamoto was published, I think, toward the end in November or December of 2008. And just quick, from a show of hands in this room, how many folks have actually read the Satoshi Nakamoto white paper? They have. It's a good 10%. For anyone who has an interest in the space, the paper is 9 pages long, and that includes footnotes. It's not that long. It has some math in it. I skipped over the mathy part sometimes too. But it's fundamentally understandable, and I would highly encourage anyone who is interested in this space to go back and take a look at the paper, October 2008. The first Genesis block, so the concept was published online in a forum for cryptography and financial cryptography, which is what this was called at the time. And it was basically just another idea that people started using. Fundamentally, though, it differed in a critical way from everything that came before it, which is it had a purely peer-to-peer basis. There was no center of trust. We'll talk about that in a little bit more detail. And by having no center of trust, it addressed the single biggest problem of the day. No one trusted financial institutions. I mean, as you recall, and most of us can recall, October of 2009, it was a very, very scary time. And there was a lot of concern about whether the financial system was able to survive or not. So this idea that whoever Satoshi was introduced takes this idea of money and moves it forward to the internet age and creates something that a good friend of ours calls value technology. It's if the internet created information technology, what Bitcoin did was create value technology. Why did the idea of Bitcoin start to catch on? Initially, it was really only used by computer geeks, people who considered it a novelty, something that really had no meaningful value, at least initially. I don't know if anyone here remembers there was the first big crisis that Bitcoin faced was the failure of the main exchange that was used to trade Bitcoin. That was called Mt. Gox. And Mt. Gox was a Japanese exchange that failed. I don't know if anyone knows what Mt. Gox stands for. It's actually Magic the Gathering Online Exchange. This prior to trading Bitcoins, it actually traded trading cards. It was a place for trading kids' trading cards. So that's the level of technology, that's the way Bitcoin was seen, and that's the level of professionalism or lack thereof that applied to Bitcoin. People started to look at it though and realize that this was much, much more than a toy or a novelty, a trading card game, but it was highly resistant to any kind of tampering, and we'll talk a little bit more in a moment about how the fundamental system works. But the idea that you could have a store of value, as Rodrigo was saying, that actually, no matter how hard people try, they could not alter the system, was extremely attractive. And people started saying, I would like to have some of this. And of course, as it traded, the price started to increase, and that created what for a time was a very virtuous cycle of continued interest in this. We'll talk a little bit more in detail about the protocol, but here what I want to do, and this slide I think sets out just at a high level, and again we'll have copies available for those who are interested. When we think about blockchain itself, we realize that the ideas that underlie Bitcoin can be used for many, many other things. And they can create what computer engineers and software engineers think of as a software stack. That is an interrelated set of technologies that ultimately build up to something functional that we can use. And people say, well, this is all very interesting, Lewis, but in my real life, I'm not going to go to Starbucks and spend a big one Bitcoin or a tiny slice of a Bitcoin to buy a cup of coffee. Why do I care about any of this? And that's because we can create a stack of software that starts to do things that are very valuable, like data storage, like offline computing, governance rules. There's a system called Aragon that allows people to have decentralized governance. There's a whole range of things that you can start to build with this technology that become extremely valuable. And they start with basic internet protocols, TCP/IP, which at least most folks have heard of, which is the protocol that runs the internet itself, and then builds on top of that. And the ability to build up on top of this is what creates a lot of interest. And when we talk about token sales, we'll talk about why money is flowing into the space, because people want to own the ability to run these protocols, and that's where value gets captured, and we'll talk about that in a lot more depth. I mentioned before the Byzantine generals problem, we'll talk a little bit more about that, but fundamentally, if we go back to the stone island, the stones of the island of Yap, the idea of consensus becomes critically important, and it's really crucial to what Satoshi Nakamoto came up with the idea of Bitcoin. That is to say, there is a single truth if everyone participating in that system all agrees, if consensus is reached as to how the value is held. So in the island of Yap, social measures got everyone to agree. If a rogue person says, oh, the stone that fell into the ocean, that doesn't really belong to family X, people say, no, you're ostracized, you're not with the program. How do we achieve consensus in a world where the internet doesn't know who people are? And that's the problem Satoshi Nakamoto solves with a process known as proof of work. And I suspect folks have heard at least the term proof of work. Would anybody, if they wanted to, give a definition, besides my colleague Jacob, of what proof of work is? Just, I'm not going to make you say, but like, do people feel they know what this concept even means? No. And it's a difficult concept. The question is, when you have a ledger, the ledger has a state. So Rodrigo has 5, and my colleague Jacob has 4, and Professor Seira has 2. This is the state of the ledger. This is how much anyone has of whatever it is you're trying to measure at any one time. The state of the ledger progresses when Rodrigo sends one of his 5 units to me in exchange for whatever value I provide to him. The state of the ledger changes. How do we know that that's a valid change in the state of the ledger? If all of you keep a copy of that ledger and it knows that Rodrigo has 5 and now he wants to send one to me, you can all check and make sure that's a valid transfer yourselves. But how do you know that everybody else is doing the same thing? How do you know that everybody is in agreement? And proof of work is the way that's done. We nominate one of you guys to be the arbiter of this particular state transition. The ledger said this, now it says that. One of you guys is going to be the arbiter who updates that ledger. How do we decide who gets to do that? We make you all do a lot of work. It's sort of the rough computer equivalent of saying everybody got to run up the stairs all the way to the top and back down 10 times, and whoever comes out first gets to update the ledger. What we do in proof of work is we make computers run up the stairs up and down, up and down, up and down by doing a very difficult computing problem. The real work, time, cost, and energy of making the computer do that work, the equivalent of running up and down the stairs, ensures that whoever I pick to, or whoever randomly gets chosen, is more appropriate, to update the ledger, is going to do so honestly, because if somebody does not do so honestly, there's somebody else who will be able to say, oh, you didn't do that right. It's a little more complicated than that. If I keep talking, we'll never get anywhere. But so proof of work fundamentally involves selecting someone to update the state of the ledger and keeping them honest by making them do real-world computing work that ensures that they're spending energy to update the ledger. Another method of achieving consensus is known briefly of proof of stake. Everybody has probably heard that proof of work, because it takes a lot of computing energy, consumes a lot of electricity and is not necessarily the best thing for the environment. Proof of stake is the idea where we can achieve the same thing. I'm going to call on one of you guys to update the ledger, and you're going to put $10,000 on the table. And if we don't think you updated the ledger correctly, you lose your $10,000. If we think you did update the ledger correctly, you get $100. So the risk of doing it falsely is you lose $10,000. It's not really worth it. You'd rather just get updated correctly and get $100. That's the broad idea behind proof of stake. And I think we're switching back to...
Sure.
Yeah.
So one of the other kind of main fundamental pinnacles of blockchain and Bitcoin is the distributed ledger aspect, right? So you guys can conceptualize this as opposed to having the traditional, what's called a client-server architecture, where you have one central party that controls, basically holds the pen on the ledger, and they get to decide what is inputted and what sort of changes are legitimate or not. The idea here is you're going to have every participant in the network have their own copy of the ledger that is going to be automatically updated via this consensus mechanism, so that everyone's going to be able to look at the current state of the ledger at any point in time in an updated manner. So this has a couple of benefits and a couple of drawbacks. I mean, the drawback is maybe the most clear to see, right? This is a redundant system, and it's one that has redundancy on purpose. It might be much cheaper to have one computer hold the ledger than have to have 15 or 100 do it, right? But what this redundancy does is it gives you, first of all, it gives you more security. If one of these computers in a mesh network goes down, the rest will still be up, and the ledger will therefore live on, right? So, for example, with the Bitcoin network, as long as there's one node that's connected, that you can repopulate the ledger from that, right? So it'll live on, it's more resistant to attack. It doesn't have what cybersecurity experts call a single point of failure, right? If you think about like the Equifax hacks, the reason why these things are so scary to us is because you have one party that has a key and is holding all of our data. This is the opposite. Everybody holds it, but everybody holds it encrypted so that not everybody can just read it. The other benefit of this is that now you don't have one person who dictates what the truth is. So it's a censor-resistant system, right? You need to be in agreement to be able to update the ledger. So if you think about, a certain institution having its biases, they're going to offer access to certain people, or they're going to represent a certain understanding of the truth. And if they're in a centralized system, they have the authority to do this. In a decentralized system, it becomes much harder. The last fundamental part of the blockchain project is cryptography. This is actually a lot of, at least what went into the Bitcoin white paper, was not terribly new cryptography. The fundamental innovation is attributed to some Stanford researchers from, I think, 1976, and it's called public-private key cryptography. And a way that you guys can conceptualize this advancement is, before public-private key cryptography, what you had was basically, if you think about two people trying to send each other a message that they want to encrypt, you would encrypt the message and then you would send it along, and then there would be a key that would decrypt that. So think about like the World War II movies, right? So then the issue with that setup is that if anybody discovers that key, then you can already unscramble the message. You can read the message, basically. So it's like you see these spy movies where people get the enigma and they are able to break the code. So what public-private key cryptography does is it allows you to broadcast a public key, which is your address, and send messages that are encrypted. And what you do is you just log into your own private key, but that private key is never shared. So think about it as your email. So instead of sending like a message that's scrambled and then you have to send a key versus another means and say you unscramble it with this, you have your own secure email address that only you can log on with your password. So that's basically the fundamental cryptographic. So moving on, what are the main problems that the Bitcoin white paper solved? So the main problem is what we refer to as the double spend problem. So in our digital lives, we're used to thinking of things as replicable and infinite. So if I take a photo with my phone and I send it to my mom, that doesn't mean I lose the photo, right? Like I just made a copy and I sent it to them. This was the fundamental problem that the media industry was wrestling with the advent of the internet and things like Napster. It's like you can now copy assets and distribute them, ad infinitum. What Bitcoin does is it's able for the first time to create like scarce digital assets. And with this, it prevents what is called the double spend problem, which is me spending the same digital asset twice. Like in the same way that I could send a photo to all my friends and not lose the photo, I might be able to do that with the first iterations of digital cash. But that will obviously defeat the point, because for an instrument to function as money, it can't be replicated infinite times. So that's the double spend problem. The other problem that we've alluded to repeatedly is what's called the Byzantine generals problem, and this is kind of like a classic game theory setup. If you think of like you have a bunch of different generals that have their armies, and you're all about to raid a town, and you're sure that if everybody attacks at the same time, you'll be victorious, but you can't really observe others, and you think there's a traitor in the ranks. How are you able to structure it so that you're able to prevent the traitors from succeeding, right? So this is what Satoshi Nakamoto, whoever she, them, or whatever it was, were able to ingeniously solve with kind of a game theoretical approach and the consensus mechanism that we've described a little bit earlier. If we think about Bitcoin, the first application, or I guess the application that Bitcoin was designed to do was payments, peer-to-peer payments. And that was the focus in the beginning for many of the people that were involved in the space. But if you start peeling back the layers and you start thinking that what blockchain truly is just a ledger, it's a mechanism, it's a social technology to come to consensus about the status of a ledger, then you can start to realize all the distinct applications that this technology could have, right? So this is, considered as a meta technology because not only is it composed of many different technologies: cryptography, software development, game theory, but it's also can apply to many other technologies. So we can use ledgers to confirm ownership. So there's a lot of projects, for example, about putting real estate on the blockchain, like having a title registry on the blockchain. And what that does is it would make it so that everybody is able to see the transfers in title, and potentially also provide people that haven't been able to prove their ownership of title with a source for collateral. And we're moving on a bit. Sorry.
Okay.
Maybe back one.
Okay. Back. Go back. Still with
One more.
Back.
Forward.
Forward.
And one more. Yeah, there. Anyway, so there are many different applications to ledgers. So moving forward a little bit, you can start on the screen. We have a couple of different developments that have happened since the Bitcoin white paper. I think the most fundamental evolution after Bitcoin was the Ethereum white paper, and what this did is introduced the concept of blockchain, sort of smart contracts in blockchain. So smart contracts have been around predating blockchain. They were developed by this guy called Nick Szabo, who basically thought of them as conceived it was like an ATM on steroids, and this is a self-executing agreement based on code. So what Ethereum did is it introduced a more sophisticated computer language called the Turing Complete language, which is Solidity, that allowed coders to use the blockchain infrastructure layer to develop smart contracts. So if Bitcoin allowed you to say, I'm going to send you a Bitcoin peer-to-peer, what Ethereum did was allowed you to do that conditionally. So now it says, I'm going to send you an ETH in the case that X happens. So if you start kind of extrapolating from that, from very simple building blocks, you can start to model complex financial and other relationships. So we also have what are called dApps, decentralized applications, and these are basically like the end user applications built on top of blockchain. Decentralized autonomous organizations, which are, I think here's the coast.
Yes.
So what DAOs are, it's basically using smart contracts to try to replicate the governance of a firm. So if you can conceive of this as, I think maybe some like the structured finance products might be a way to understand it. So it's like if you have a pool of money and you just have pre-existing rules about how that money is going to be invested and how the proceeds of that money are going to be distributed. So the first attempt at this was actually spectacularly unsuccessful, and it was called the DAO. And it was a VC fund. So people invested their cryptocurrency, and they had a consensus mechanism whereby they could select the different investments that this fund was going to make, and they had pre-existing rules about how the returns were going to be distributed. Unfortunately, it got hacked really quickly and resulted in Ethereum having to be forked and a lot of drama in the community. But it's a very interesting development that raises a lot of legal issues about corporate personhood, liability, and others.
So far, a lot of theoretical materials being covered, and it's a little bit hard sometimes to kind of relate. What does this mean to me? What does it mean to my life? What does it mean to me as a lawyer? What does it mean to me as a business person? Rodrigo dropped the reference to a well-regarded economist named Rodrigo Seira. There was a typo in there. There's a D on that. Ronald, yes. So we'll fix that in the version that goes out. Coase was an economist who worked primarily out of the University of Chicago. He was very focused on the topic of law and economics, which I'm sure is Professor Gustav was one of her favorite concepts. But I want to talk about that, come back to that briefly to talk about what an ICO is and why that's so relevant and why it's relevant to your life. Fundamentally, what Coase asks is the question, well, if markets do such a great job of allocating production and consumption through the pricing mechanism, Why do firms exist? Firms are plainly not themselves market-oriented entities. They may function within markets, but within a firm itself, there's a command and control system. There's a CEO, they give directions, there's little or no market input. He asks this question, he answers the question by saying, well, the reason you need firms to exist is, number one, transaction costs. It can be very difficult and time-consuming to create transactions, and you need to share those costs in some sort of way, and firms are a very good way of doing that. And certainty of outcome. In many cases, you may enter into a transaction and not have a high degree of certainty. You may have to pursue remedies, you may have to have market power, you may have to have a variety of things to address the lack of certainty of outcome. And then he goes on to hypothesize in an essay called The Nature of the Firm from 1937, which I highly commend to anyone interested in this topic to read. He goes on to say, well, what if we had an environment where we had very low transaction costs, low to zero transaction costs, and a high degree of certainty of outcome? He said, then you wouldn't need firms. Well, holy cow, 1937, he predicts the idea of dApps and DAOs, because that's exactly what we do with blockchain. Now it starts to become more relevant to our real life. Now what we can do is we can actually reduce transaction costs. We can create peer-to-peer markets where various things can be traded, not just Bitcoins themselves, but file storage, computing power, all kinds of things that we're very fortunate at DLx to be working on a whole range of things where people are using decentralized applications to create markets and all kinds of different things. And we're reducing the transaction costs by using this technology that works very smoothly across the internet. And we're also, hopefully at least, reducing issues around certainty of outcome, because as Rodrigo explained, smart contracts, generally speaking, execute themselves and you don't have the ability to dispute them. Now, things can go wrong as they did with the DAO, but that makes lawyers have jobs, right? So it's very interesting to think about this. So now we can create a new kind of economy, an economy built on peer-to-peer markets rather than firms. And we ask ourselves, so is anyone in this room familiar with a token project called Filecoin? My colleague again. You're banned from this. Filecoin is a blockchain project that's seeking to create a peer-to-peer market for file storage, something very simple, something we all have. Who out there, went out one day, and maybe it's Friday night, and they had nothing better to do, and they find themselves in the Best Buy, and they buy that 4 terabyte, hard drive, and you got no idea why you need it or why you even bought it, that you bring it home, and it's sitting there, and it's mostly unused. And you think to yourself, gosh, I got all this file storage, and it's not doing anything, maybe I just put it in the basement and forget about it. Well, in fact, Filecoin posits the question, what if you could get paid for that? What if folks, kind of like Airbnb, but on a decentralized basis, say, I'll put my data on your hard drive, and I'm going to pay you maybe $20 a month, just to keep your hard drive plugged into the internet. What if everybody creates a marketplace in online storage that's redundant, so one guy takes this thing off, you don't lose your data. All of a sudden, you have Dropbox without the company. You have a protocol doing the same thing that a company currently does. We all know Dropbox, most of you guys have it on your phone. All of a sudden, if the Filecoin protocol works, you have a protocol layer that does the same thing that a company does today. But here's the interesting thing. If you're interested in Dropbox and did do an IPO, you can buy their shares. You can own shares in Dropbox. You're a company and you get all the things that go along with it. If you want to invest in Filecoin, there's no company to buy shares in. You can't even lend money to them. They don't exist, at least at the protocol level. All you can do is buy a token that lets you participate in the system. And because there's a finite number of tokens, if there's an increase in demand for this system of online storage, and there's a finite number of tokens, what's the one thing that can happen to the price of those tokens? Price goes up. So you get to participate economically in the success or lack thereof of an online protocol, and you do that using the techniques that we've been describing for the last half hour, and you think, oh my God, when are you going to stop describing techniques? What you can start to do is create new systems, new ways of doing business, and new types of investments. And of course, the investment community has become very interested in ICOs. ICOs is the unfortunate term that's used when these tokens are sold. And I see Rodrigo is giving me this sort of high sign by flipping pages very quickly, so we've got a lot more material to cover. But I think it's critically important to understand how we go from the Stone Island of Gap to Filecoin and ICO and all of a sudden raising money. And this chart here shows the tremendous global interest in this concept. And it goes from next to nothing, as you can see, in 2014, and probably that was the Ethereum ICOs back around then, to an apex of, what is that, 6 billion, something like that, of funds raised. So capital is intensely attracted to this idea of having a new way of participating economically in network effects. If you were interested in the network effect of Facebook, you had to buy Facebook shares. And in many cases, you couldn't buy Facebook shares. And in any event, you weren't getting a pure exposure. It might be the difference if you think about Facebook. It might be like buying the shares of a gold mining company. And yes, you were getting exposure to the price of gold, but you're really getting a lot of things that go along with it. You're getting Mark Zuckerberg and all the baggage that comes with it. If you buy tokens, it's like buying pure gold. It's like buying a commodity. You get the thing itself. And if there's an increase in demand, if someone comes up and creates a new commodity, say an orange, no, I'm not going there. If somebody creates a new type of commodity, and you participate at a very early stage, you can have tremendous growth in value. So when Ether, the native token of Ethereum, was first sold, it was about 15 cents. At its apex, I think it was at 1,600 bucks, something like that for a single token. So that's really a lot of wealth. So you put $10,000 into Ether back in 2014, and you're a billionaire. So this gets a lot of folks' attention. And that's what is creating this interest. Unfortunately, it also attracts a tremendous amount of fraudsters, charlatans, carpetbaggers, and everything else along the way. And it is truly a buyer beware sort of environment. Let's talk, I guess, a little bit about regulation. You want to pick that up? Okay.
I guess I'm the theoretical guy, so taking a step back. When we think about regulating the internet, I think the threshold question is, can you do it? To what extent can you do it? And there's a lot of parallels between the discourse in blockchain regulation to the discourse that was around in the 90s with the internet, right? So there's this idea that basically the internet is removing intermediaries. It's not physically conducted, so there's a limit to the agency of governments to regulate it, right? Some of you guys might have heard the phrase code is law. And this is this idea from Lawrence Lessig, which I think is somewhat misunderstood and kind of tortured into meaning code replaces law, which is not the case. And we're here to kind of show you guys why. But first, I would like to point to the meme, which is a big thing in the crypto community, and I've tried to scribble it in for your amusement. So this is the idea that, even if the government tried to shut it down, they wouldn't be able to, because there's no real intermediaries, and because there's a lot of it is automated in the protocol. I guess one other thing that I'll point to is there's a pretty influential book out recently by Aaron Wright from Cardozo and Primavera de Filippi, which tackles this kind of head-on, and I would recommend it for you guys if you'd be interested. Can we get the next one? So unfortunately, you can't really read that, but this is talking about Lawrence Lessig's kind of conception of regulation of the internet, when he was talking about what are the different factors that influence an individual's behavior. And he points to norms, so social norms, what is socially acceptable, the market, what is accepted by the market, the law, what are the applicable regulations, and importantly, the architecture. And this is where this point about code is law, it comes from. And what he's basically saying is, by structuring the architecture of a protocol, what that does is it limits the types of interactions that you could have. So in that sense, it's influencing your behavior. It's making you, it's limiting you and the things that you can do and allowing you to do some things. The second column is from Aaron Wright's book, and here he goes into depth a little bit into the different kind of vectors of regulation in the blockchain industry. So while you might at first sight think that this sector is not regulatable, in fact it is. And it's, if you take the history of the internet, it might become a very highly regulated space. I'll try to take through some of these quickly, mindful of the time. So the government can regulate end users directly, right? So crypto holders. You could ban you can ban businesses from accepting Bitcoin. You could ban your citizens from transacting in Bitcoin. So that's one level, right? The second level is the transportation layer. So we have internet service providers that are kind of the fundamental infrastructure level that the Bitcoin protocols are based upon. And these can be regulated as well. The US has not regulated ISPs historically, but a place like China has. And it's kind of a blunt instrument, but the lever here would basically say, you ISP providers have to screen traffic on the internet or we're going to come after you. You could also regulate information intermediaries. So in the height of the 2017 ICO hype, Google and Facebook dropped ICO ads. I don't know if anybody you guys noticed that. So that was part of them realizing that they had some liability here, and they were kind of scared about what was happening. They didn't want to provide too much marketing for what they thought might be fraudulent products. So the government could do the same thing. The government could force Google to delist anything and de-index anything that has to do with crypto. So it'd be very hard for anybody to find crypto projects. There's also blockchain-specific intermediaries, and I think these are some of the folks that we work with the most, and they're highly regulated. If you think about centralized exchanges, so Coinbase in the US, there's Kraken, a couple of them, are basically marketplaces that, I guess, the heirs to Mt. Gox have become more formalized and like really big businesses that are making a ton of money. Coinbase, the US one that I mentioned, had over $1 billion revenue last year, so nothing to sneeze at. But they're obviously a vector of regulation, and they've had to recently implement a lot of KYC, AML procedures to protect themselves from liability. There's also the miners in the system, which are the transaction validators, which are the folks that are part of the consensus mechanism doing these computations to try to race to get the answer. So they have a very interesting role in the network because they get to basically say what's true at the end, right? So those are also a vector of regulation. You can regulate code. You can make, you can force developers to put backdoors into protocols like the government has done or tried to do for electronics. And then it's the hardware manufacturers and also the market. They could have taxes or do other sorts of regulation that affect the pricing of it, and then in that way regulate the space.
So that's a look at regulation of the technology and of the various components of the technology. And what's interesting to me is while everything, Rodrigo, that you said was accurate, at the same time, there are reactions in the blockchain community to each and every one of those vectors of regulation, because in some respects they could be looked at as attack vectors, as someone might view hacking as an attack vector, regulation as an attack vector. So for example, people are working on decentralized internet mesh networks that actually cannot be controlled by the government because they're not controlled by any one single source. They're looking at power supplies that are decentralized. They're looking at systems. And there's two sides to everything. While on the one hand, we certainly don't want terrorist activities to be using cryptocurrencies to fund the next attack on the United States. At the same time, we don't want, as in China, where every activity is completely controlled by the government. So it's a really interesting question. Beyond those various high-level vectors, we have some very practical vectors. When you're selling a token, are you engaged in the sale of a security? This is a very difficult question. The SEC is quite interested in this question, and state securities regulators are quite interested in this question. There's a huge amount of law around that. The CFTC believes that Bitcoin, Ether, and other cryptocurrencies are commodities. A future or derivative involving a commodity is subject to regulation by the CFTC. They also have jurisdiction over the spot markets where fraud takes place, so the CFTC is very much involved. Banking regulators, in particular the Financial Crimes Enforcement Network, which is part of the Treasury Department, is very, very interested whenever a virtual currency is used, because that becomes potentially a money transmission methodology, and something at both the federal and the state level that is potentially quite concerning if it's used for improper purposes. And of course, the tax guys are always interested in this, who's making money and why. Rodrigo alluded to the fact that Coinbase got into a very public dispute with the IRS about revealing the names of their customers, because the IRS did some simple math, and they said, Coinbase is claiming, $1 billion of sort of revenue, which kind of imputes to a certain level of trading activity, and yet we're only seeing this tiny amount of Bitcoin gains being disclosed across all our tax returns. Something's not right with this picture. And of course, OFAC, the Office of Foreign Asset Control, is interested when foreign players are involved in the United States. A little more detail here, because we're a law school, so as I'm sure you know, if anyone's taken securities law, the Section 5A of the Securities Act of 1933 prohibits the sale of a security unless it's either registered or exempt. And again, we have very difficult questions about whether a particular activity relates to a security or not. Blockchain-based tokens don't seem to fall into any of the major categories in Section 2A1 of the Securities Act, and thus seem to fall into the catch-all category, which is known as investment contract. As folks have now beaten to death, the primary interpretation of the term investment contract is in a case, SEC versus Howey, that involved a scheme involving in real estate with orange groves, where people were induced to buy contracts and were told they were real estate contracts. The SEC prevailed in a case that actually what was being sold was an investment contract. And they were able to use the enforcement mechanisms of the Securities Act rather than more difficult mechanisms that would have applied to a basic real estate contract. Particularly here in the US, we've had limited but very important and valuable regulatory guidance from the SEC. Rodrigo had alluded to the mess that was the DAO, the virtual VC fund that you described earlier, and the SEC a year later in the summer of 2017, about a year ago now, released a report, critical reading, that describes their view of what happened, and it's simply a report. It's not an enforcement activity, but it's important reading. Subsequent to the DAO report in the summer of July, I think, of 2017, there were a number of enforcement actions, but those were against clear people operating frauds, where there was deceit, where the money just disappeared. They were low-level kind of criminal guys. What that changed in December of 2017, when the SEC went after a token sale by a telephone, a mobile phone app called Munchie, there was no fraud alleged. They were simply trying to sell tokens to build a dApp for their phone, but the SEC felt, and I would certainly agree, that the way the tokens were marketed, the manner of sale, implicated the securities laws, and they made a public offering, and they didn't register or have an exemption, and that provided a tremendous amount of guidance. More recently, a week or so ago, an enforcement action against a token sale known as Tomahawk focused on the concept of airdrops, tokens that were given away nominally and therefore couldn't possibly involve securities, and the SEC looked more closely at what was done, and they recognized that the tokens that were nominally given away were actually being given out in consideration of marketing activity, which had value, and the SEC found no, absolutely still sale of securities. I certainly would advise airdrops unless you're extremely cautious, and of course there have been a variety of other activities. There's an interesting question of if, when, if ever, the SEC will issue a no-action letter in this space. We're fortunate enough to be working with some folks, and we'll see where we come to on that, so definitely it's a watch this space. We don't have it on our list here, but another important regulatory guidance is a speech from Director Bill Hinman of the SEC, which was given about a month and a half ago now, where Director Hinman lays out some of the criteria that he believes are most relevant in determining whether you have a sale of a security or not. Interestingly enough, the SEC chose to put the speech in the words of the director rather than the commission itself, which gives them some wiggle room if they decide to kind of go in a different direction. Very quickly, as we move along here, when you sell securities, as we said, here's a quote from Commissioner Clayton where he says he hasn't seen any sales of ICOs that he didn't think involved sales of securities. And while we haven't reviewed each of the 2,000 some odd ICOs that have happened, I probably would tend to agree with them. There are different ways of approaching this. Some folks have tried to say, okay, we're not going to do an ICO, we're not going to create a kind of traditional ICO type token. We're going to just have a security that represents either equity or debt or something that you're all familiar with. And we're going to sell it either pursuant to Regulation D, which many of you should know is a safe harbor for private placements of securities in the United States. They might choose to sell it in a Reg A offering, which is an exempt type of public offering. It's a very special type that was expanded significantly under the Jobs Act. They might try and use crowdfunding. Crowdfunding is limited to only about $1 million in funds, so it's not the most helpful means, but it might be used in conjunction with something else. Or you might just stay out of the U.S. entirely, which a lot of clients are choosing to do. Again, if you're selling something that is not intended to be a security, our advice would be, one, seek a no action or other relief, or you know, take your chances, or wing it. That would not be our advice. The winging part, not our advice. ETFs, there's a lot out there on that. It's a fascinating area. I'm not going to spend too much time on that now. An ETF is an exchange-traded fund. It's a way for retail investors to get direct exposure to either a pool of stocks or a pool of commodities. About 10 years or so ago, Barclays at the time came out with the first commodity ETF involving gold. It's a very interesting story because when you think about it, and I referred to this earlier, prior to the first gold ETF, it was really difficult to take direct exposure to gold. I mean, you could buy a few kilograms, but if you wanted to put, say, $10 million or even $100 million into gold, very, very, very impractical. You had to buy stocks and mining companies, which again were not a very effective means of doing that. Somebody came along and took a whole heck of a lot of gold, put it in a warehouse, and started selling certificates and said, hey, when you buy the certificate, you're getting the gold or your piece of the gold that's in the warehouse. And in that way, you could trade it easily and get exposure to the underlying commodity. People said, hey, Bitcoin's a commodity. Why can't we do the same thing with Bitcoin? We'll put a bunch of Bitcoin in the equivalent of a vault somewhere, and then we'll sell easily tradable certificates on that. The SEC had rejected that idea last fall and recently rejected, I think, 9 separate attempts and slightly different variations to create a Bitcoin-based ETF, ostensibly because of concerns of the accuracy of the underlying pricing. There's a lot of debate you can have about that, but it's interesting the SEC is still showing a lot of caution about how we give retail investors exposure to a commodity like Bitcoin. I think this is more of that. Love that. Why is this important at a higher level? So this is really interesting from a business point of view, it's interesting from a theoretical point of view, but it's also interesting from a competitive point of view. The internet was developed at a time where nobody really saw it as a competitive tool to grow your business. All of a sudden, blockchain is being looked at by countries around the world as a way of actually supporting growth in their economy. And this is really important to understand. We're seeing a whole variety of countries devoting a tremendous amount of energy. China has, here in this case, we're saying, banned certain activities, but at the same time promoting investment in Bitcoin, and it's actually not Bitcoin, but in blockchain technologies along the way. Malta has created a licensing framework in the sandbox, and they want to be sort of put themselves on the map as a center of blockchain activity. France is moving very, very quickly to create a blockchain-friendly regime in France with the hope to attract business. Gibraltar is another. Some rogue countries have even, jumped on the bandwagon, and Venezuela has created a ostensible cryptocurrency that I think nobody really buys into. It is what it is. Do you want to pick up on some of the open regulatory issues? I think that we're going to move to Q&A.
Sure. So I mean, one of the exciting things about this space is that for lawyers that a lot of the law is not clear. Here it's just kind of like a random sampling of open regulatory issues. So thinking about which are the regulators that are going to really exercise jurisdiction over this space. At this point, at least in the U.S., it seems like everybody's kind of trying to get into the mix. You know, you have the SEC saying they're securities, CFTC saying they're commodities, the IRS they're saying they're not currencies, they're property, they're taxable, you can trade them. So it's kind of shaking out of the institutional side of this, who's going to be regulating it. There's also not a lot of regulatory guidance on what exactly are the parameters of issuing a non-security token. And there's also been a lot of focus on this ETF, and I guess just a quick other point on the ETF front. I think there's specific pressure on this point because it's seen as a means to allow the retail sector to get exposure to high-growth tech companies. So one of the big promises of the ICO craze phenomenon was that for the first time, retail investors were able to buy, get some of this exposure to the big tech companies, which are usually, this exposure is usually limited to, you know, the big guys on Sand Hill Road, Perkins, the big VC funds, right? So as the regulatory response to ICOs has gotten more stringent, ICO issuers have been moving towards a framework that relies a lot on private placements and stuff like that, which ultimately leads to the same types of investors being given these exclusive opportunities, and therefore the retail sector being shut out. So people think of an ETF approval as a way to be able to involve the retail public more in this sector. And then a personal one that we've been kicking around the office is kind of like, how are we thinking about developers and the different participants in this network in context of like corporate law? What sort of duties should they have to holders of tokens, if any? So with that, I'd welcome some of your questions.
All right. Thank you so much, guys. Just sitting down because we have only 3 mics, and Habiba, could you please help me out here? I think it's still on. So, thank you so much for this fantastic presentation. By the way, Lewis's references to Professor Seira just reminded me that I completely neglected to introduce myself. No surprise there, because most of you are my students, but we also have guests. So my name is Lewis Cohen, and I'm an associate professor of law here at Rutgers. And now, without, again, further ado, let us take the first question. John, just 1 second, since we're streaming this event.
So today, Vermont enacted a statute that allowed for blockchain-based limited liability companies to exist, and I'm wondering what your view is on how a truly decentralized company could exist, especially that last question, if there's no actual fiduciary who you look for to sue. Do you have any idea like how its kind of structure could exist in today's world under the current regulations that we have?
Sure. Well, I think I'd start by questioning the way you framed your question, which is a decentralized company. When you use the word company, you already make a prejudgment about the legal nature of the arrangement. I think probably you couldn't have a decentralized company, but you could have a decentralized protocol, a protocol that accomplishes things. The computer protocol is not a company, it's simply a code base that people interact with and produces various outcomes. In that sense, you can think about any of these things as decentralized protocols. Rodrigo earlier explained or made reference to Professor Nick Szabo's concept of smart contracts, but basically it's an automated rule set. You do something, something else happens. In the case of the DAO, you do something which is transfer Ether to a smart contract address, something else happens, people get to vote on how that Ether might be allocated. That's a rule set, it's not a company. And so I think any future approach like that will be involving protocols and rule sets rather than legal entities that are decentralized themselves.
So, if I may, just using the privilege of the person with the mic, the working mic, may I ask a question? So, we have smart contracts, we have the concept of the DAO. Basically, just for the folks out there who are not experts in this field, can Facebook or Uber be replaced with the code, and once the code is in place, or will firms, going back to your codes reference, will firms switch to ICOs, let's say from IPOs? And if they do, will the ICO market become the next NASDAQ or another exchange? It's a theoretical question.
Sure. So I don't really see the contraposition of those two positions. I think the first statement kind of asking whether Uber could be replaced. I mean, I think theoretically, yes. There are a lot of kind of technical issues that you would have to work out. But the idea there would be basically just you have a network similar to the one that Lewis described when he was talking about Filecoin, where users would just sign up and perform the labor and they get paid in a closed economy circuit. I think there's people that are definitely looking at doing that. I'm not sure if I would buy their ICO. But on the view, the way you framed that was like, or a company is going to be doing ICOs, public companies. So I think that blockchain is definitely going to revolutionize fundraising. I think when we put a chart up about 2017, if you compare VC funding for internet companies versus the funding that they got through ICOs, people raised more money doing ICOs, even in 2017, right? So I think the kind of proof of concept for that at least is there. And now you're seeing a lot of more traditional operating companies looking at this, starting with folks that are acceptably a little bit on the fringe, like Overstock, but people are starting to look at this, and while there are some of the potential benefits and liquidity and kind of like having a different investor base might not be fully developed, I think that's definitely where the market is going. So I guess to take it a step back, I would say yes and yes.
And just,
So it's not an either or.
yeah, no, I'd absolutely agree with that, Rodrigo. And just to give maybe one other example of interest, you ask about a decentralized Uber, and I absolutely agree. There's, in theory, yes, but many, many, many steps away from that. But let's think about something that's a little bit more readily achievable. So it seems quite likely that in the reasonably near future, 10 years-ish at least, we'll have autonomous vehicles, right? Vehicles that can drive themselves. Well, could you have an autonomous vehicle that owned itself? So that actually didn't have an owner? So the autonomous vehicle is served rides from a decentralized server. So you want a ride, you put something in, and it serves you up an autonomous vehicle that happens to be within reasonable distance of where you're located. You pay it with cryptocurrency. It takes you on the ride wherever it is. It's programmed, and after a certain number of hours in service, it's programmed to go to a garage where it gets service, and then it goes back out on the road again, and it uses the cryptocurrency that it earns from the rides that are paid to it to pay for the servicing that it gets from a service station, and it just keeps going around in circles like that. Sir?
I don't know if we need the mic. So,
Why close?
I'm surprised you remember my name. It's been 2 years.
Well, many of you are students, so.
Okay, so in the example that you just gave of this kind of decentralized autonomous vehicle, would it be in essence a zero-sum game where the kind of anticipated currency in would be calculated to meet the needs of whatever electronic charging, gasoline, maintenance fees, and no essential kind of accretion in wealth to the vehicle because the vehicle in and of itself wouldn't be cognizant enough to discharge that wealth? Do you know what I'm saying? Like, would there be some pooling of currency in the vehicle, or would it be zero sum where it just kind of
Yeah, it would depend on how you write the rule set. I mean, maybe the vehicle would buy some cool skins, right? You know, oh, I made some extra money. Its rule set says if you're running a surplus, buy a cool skin, maybe get some more in. You know, the rule set would drive the behavior. That's fundamentally what we're talking about. Obviously, that's, you know, a slightly extreme example, but it's one that you could imagine within 10 years happening for sure.
And also, someone has to produce this vehicle and equip it with the proper code, etc. And that someone probably will want to be remunerated somehow.
So just a quick question regarding the way the SEC has been positioning itself over the last, I guess, year. So most recently with the ETF denial, and then the later retraction or whatever actually happened, earlier the news stories, and then earlier with the Hinman speech, later Chairman Clayton went before Congress and kind of confirmed that the Hinman speech is kind of what we follow. And then earlier with the Bunchy report that you mentioned, what I don't think was mentioned was that it was a 21-A report, which I think there's only been 14 in history.
You mean the Dow report, not Munchy.
Yes, sorry. So the Dow report, and there was only 14 or so in history. So instead of prosecuting, we're trying to find refund for people. What do you think the SEC is trying to say with each of those positions that they're making or taking?
So, I mean, I think the SEC is playing a balancing game between trying to balance a couple of interests. They obviously have a mandate to protect consumers and make markets transparent and stable, and I think that's definitely on the top of their mind. They also want to, what people always talk as not crush innovation, right? They want to be able to foment this technology, and we talked a little bit about the competitive landscape. I think a third interest of theirs is to preserve their flexibility. One of the things that I've noticed in the kind of like the chasm between the community and the lawyers or the regulators are that the community is always kind of kicking and screaming, saying we need like a bright line rule, like we need to know exactly what is the security token, what is a utility token. So I don't think that you're ever going to get that from the SEC, right? Because the SEC wants to be able to preserve its ability to really look at the facts and circumstances, look at the economic fundamentals of whatever transaction it is, and then get to deem whether it's a security or whether they get to exercise jurisdiction. So I think part of it is this game where they're trying to give guidance while at the same time, so that they're like squatting down the worst offenders, the center, the people that are lying about their bios and like their technology, and they're trying to give guidance so as to not scare the market, but also preserve whatever flexibility they might need down the road.
And if I may interpolate, there is a reason why the SEC has not been using 21A reports as some might expect them, as often as some might expect them to do. Because investigation reports under 21A, some, especially Roberta Carmel, who used to be an SEC commissioner, and now obviously she's with the faculty of Brooklyn Law School, she about 20 years ago, started criticizing those reports as a way to avoid formal procedural rule changes. And indeed, the reports give a lot of flexibility to the SEC, and they don't have to follow the APA rules for developing a certain framework. This is one of the reasons. Plus, I completely agree with Rodrigo. The reason is flexibility. They just want it. Any other questions?
Hi, my name is John. With respect to criminal aspects when it comes to blockchain, I myself have not partaken, but I know many people who have gone on the dark web and used blockchain to do illicit things, most notably quotables.
Asking for a friend.
Yeah. And well, with respect to, I guess, the implications of blockchain in criminal justice, how do you then bring an anonymous person who uses the ledger or someone who's semi-anonymous? How do you stop people using tumblers, washing Bitcoin through 50, 60 different iterations, and then promulgating illicit behavior?
So I think that's definitely one of the main regulatory concerns. I think it was kind of overhyped, in my opinion, in the beginning, and probably that was to do with a couple of kind of really dramatic stories like the Silk Road, you know, the guy like ended up getting put in jail for attempting to hire like a murder for hire, right? So like you have that kind of baggage that's still lingering. But I think if you look at the technology, you have to ask the comparative question, right? So first of all, it's like, how does this compare to cash or to some of the other methods of money laundering, which I guess is the main risk, or like counterterrorism financing, right? So I think actually blockchain and Bitcoin stack up pretty well. As you alluded to, Bitcoin and a lot of the protocols that are similar to it are actually not anonymous, they're pseudonymous. And the fact that the entire history of the blockchain is public makes it very easy to be auditable. So government agencies have the technology, and like through stuff like big data analysis, they can actually pretty much tell what some of these transactions are happening. I mean, I expect a lot of people that didn't declare their taxes are going to find that out from the IRS one way or another kind of soon. And there's actually been statements from police that have said that it's actually pretty easy to track people. You guys all probably saw the story about Mueller's indictment against the Russians and how they were using Bitcoin to try to buy influence for the elections, right? If they had been using cash, I wonder if you had ever found out about that story, right? So it was the fact that they were able to trace them by auditing the blockchain. One thing I will say though is like the rest of this technology, it does keep kind of pushing the boundaries. So the same way that Lewis kind of brought up how there's like decentralized exchanges now that are going to make it harder to regulate that kind of aspect of the technology. There's advances in cryptography, things like zero-knowledge proofs, Z-snarks, that are really going to increase the privacy and make it much harder for governments to kind of peel the layers and see who's doing these transactions. But I mean, I wonder how those are going to be regulated ultimately.
Yeah, I absolutely agree. I would just add, these are very, very difficult policy questions because there's two sides to this. On the one hand, as we said before, there's a lot of concern about the technology being used to foment, crime, terrorism, and a whole range of problematic activities. But at the same time, privacy is very, very important to a lot of people, and we're living in a world of ever-decreasing privacy. So the idea that the government knows every single thing you do at every moment in time is actually pretty concerning to a lot of legitimate folks who are not committing crimes or doing things that are valid. So while privacy coins, as you mentioned, like Zcash, are ways of potentially circumventing that kind of surveillance, there are also ways for legitimate citizens to push back on government, intrusion in their legitimate business. So there's no easy answers, and I think it's a fascinating area, and it's a great area for lawyers to really jump in and engage in.
Just back to the SEC and the exchange-traded fund. So a lot of smart people have been trying to get an exchange-traded fund recognized with a lot of money on it, and they failed. So I think what the SEC is saying is that they're worried about market integrity and they're worried about price manipulation. So this isn't price discovery, it's price manipulation. And then they're leaking on the side that the DOJ and the SEC have some criminal investigations that are pending. So what do you think is happening? Do you think this is price discovery or price manipulation, and how does it resolve?
No, I mean, you answered your own question. It's absolutely right. There's no sense of fundamental integrity in these markets. And how many folks in this room have heard of tethers? Not enough. So it's worth doing a little Google search on tethers, and an anonymous blogger goes by the name, not completely anonymous, Bitfinex. But there's a tremendous amount of debate around how a separate quote-unquote stablecoin known as Tether is being used to manipulate the price of Bitcoin. I mean, certainly all the evidence suggests that in the short run there's a tremendous amount of price manipulation. Whether that price manipulation is so severe as to circumvent the benefits of having a wider exposure for retail investors in this technology is a difficult policy debate, but certainly there's a lot of price manipulation that goes on, and the level
of integrity is low, whether it's, again, lower than some other more traditional commodities that have also been manipulated, who knows? I mean, look at the manipulation of LIBOR. So the largest banks in the world manipulated one of the widest used standards in the world and largely got away with it. I mean, there were some consequences, but by and large, for the most part, they're still kicking. So, I mean, compared to Bitcoin and Tethers, that's a drop in the bucket. So, I mean, there's a lot of manipulation out there. We just need to create markets that are as balanced as possible and to really enforce the law when people who manipulate those markets are discovered, which may be the enforcement activity you allude to.
So we have time for 2 more questions. Anyone?
I mean, I've got a question for the group. So, you know, to the extent folks here are still in law school, how many people would want to consider, you know, a practice when they graduate involving one way or another blockchain and blockchain technologies? Is that something of interest? That's great. Well, we certainly, you know, encourage that. You know, at our firm DLx, we're very small, but we do everything we can to support the community. So I would certainly encourage you to reach out, you know, to myself, to my colleague Rodrigo, our colleague Jacob Schulman is there, who hopefully will be with us.
Jacob is a graduate of Rodrigo Law School and has taken a few courses with me.
Absolutely. But to any of us, and ask us about, you know, what a career in the space looks like, how we can help, you know, feel free to follow us on LinkedIn, engage with us on Twitter, and really just become part of that community. And I think it's a very embracing community. It'll give you much more than you need to put in. Just put in a little bit and you'll get back many times fold. So I absolutely encourage people to get more engaged in whatever point in your career, in your life you're in.
Maybe I'll just take a last second to reiterate that I'm obviously someone that's pretty junior. I worked 2 years before joining this boutique, and I think that the blockchain space is just really great for a junior lawyer for a couple of reasons. I think it's going to be a paradigmatic shift that's going to come, so there's a lot of value that you can have by being able to be close to this technology and understanding it. Frankly, a lot of the people that are in positions of power right now don't understand it or don't want to take the time to do it. So it's really kind of a great career opportunity for you to get at the ground level. This field is full of people that were doing something else a year and a half ago. So you're not you know, competing against somebody that has 20 years experience in this legal field. It's also very multidisciplinary. I mean, we get to talk like, you know, macroeconomics, monetary policy, coding. It's a really cool just conflagration of people from all different sorts of places adding their 2 cents, and it's way more fun than like M&A or whatever else you could be doing.
Great. Any other questions? Then let us thank the panel.